afternoon, everyone. We'd like to welcome everyone onto this event this afternoon about the super deduction and other tax updates. It's really great to host everyone today. We've had a really good response to this event. Again, we've got a great number of attendees, so that's really good. If anyone has got any technical issues at all throughout the event, please do feel free to get in contact with us using the chat function. And we will be having a question and answer session towards the end of the event. So please do feel free to post your questions in the Q&A box as we go through. And we'll pick up those questions and we'll address them later in the event. So my name's Carl Taylor from Oldfield Advisory. And on the panel this afternoon, we've also got Jerry Surtees, who is a chartered tax advisor here at Oldfield. Hello, Jerry.
Afternoon, Carl. Afternoon, all.
So this afternoon's event is really all about updating you on some significant tax changes that have been announced recently. Really sharing some practical ideas around those recent announcements. In the wake of the lockdowns we've experienced over the past 18 months, we've really seen unprecedented government spending and unprecedented levels of government borrowing. So it's not really unexpected. It's really not unexpected that we're now seeing some significant tax changes being announced. And it feels like we may see more of them as we continue to move forward and move through and hopefully out of the pandemic. And so there's really two main announcements we want to focus on today. And firstly, it was the super deduction. So we really want to go over why the super deduction has been introduced and what it actually is, how it works. We want to go over some practical examples and tips on how you can maximize the use of this new deduction. And we really want to talk about it because it's really a very generous relief, and I don't think it's very worthwhile, and we don't really think enough is being made of it widely enough. We're speaking to a lot of businesses where the directors aren't actually even aware of what the super deduction is or how it works. So we want to address that this afternoon. And secondly, we want to talk about the new health and social care levy that was announced earlier this month. I think there's been a lot of talk and various views given on it, but we really want to just cut through the confusion and just explain clearly exactly what it is, how it will impact you, and practical considerations going forward as a result. So we'll kick off with the super deduction. We'll explain what the super deduction is and why it was introduced. So the super deduction was introduced, it was announced back in March earlier this year. And the announcement was against the backdrop of government borrowing having increased significantly as a result of the pandemic. And the government's main response to that in the budget earlier in the year was to increase corporation tax rates from 19%, as they currently are, up to 25%. So the government announced that corporation tax rates are going to increase to 25% from April 2023. And so that's quite a major announcement. It's quite a significant increase in corporation tax. And that was one of the big announcements in the budget. And the other big announcement in the budget that went alongside it was the introduction of what's called the super deduction. And so just to get a really good understanding of how the super deduction works, I think it's really probably worth just briefly going over how you normally get a tax deduction for capital spend, so you can see the context. So when you buy a piece of equipment, you buy a van, buy a piece of capital equipment, the way you get a tax deduction is different to any other normal expenditure, like buying, paper for the office or paying for utilities, that kind of thing. It's a different way. There's a different way of getting a deduction. Treat it differently. So basically, before super deduction was announced, there's really three main options for getting a tax deduction on capital spend, and you can see those on the slide there. So, for example, say you bought a van costing £20,000. By default, you'd actually only be able to write that down by 18% per annum. So you'd only be able to reduce your profits by 3,600 in the first year for that van. and reduces your tax bill by just under £700. That's the default position. And then there's other assets, other different types of assets that have to be allocated to what we call a special rate pool, which get an even slower tax deduction. For those assets, you can only write them down by 6% per annum for tax purposes. So I've got an example here, air conditioning system, it's a fairly major one, costing £100,000. You would only be able to write that down by 6% per annum, reduce your profits by £6,000 in the first year, and that reduces your tax bill by just over £1,000. So you can see that normally achieving a tax deduction for capital spend can be a very slow, painful process. It can be extremely slow. It's either only 18% or 6% per annum. Actually, what we do have though, and you can see this on the far right, is annual investment allowance. So that is something we do have, which is an allowance which allows us to offset 100% of the cost of qualifying equipment against profits in the first year. And that actually gives us a much quicker tax deduction. You can see from the example. So you're taking your van, for example, what we can actually claim is the annual investment allowance, and we can actually offset £20,000 against our profits in the first year, and that reduces the tax bill by nearly £4,000 in the first year, you can see. And same principle there for that air conditioning. It costs us £100,000, offset £100,000 against the profits in the first year. We can reduce the tax bill by £19,000. So the annual investment allowance is a great provision, and that allows us to get much quicker tax deduction for capital spend. There is a limit for that, however. There's an annual limit of £1,000 that you can claim for annual investment allowance. That cap is reviewed fairly regularly. It's currently £1 million, but it's highly likely to change for 2022. So you can see, normally it's very slow to get a tax deduction for capital spend. The annual investment allowance helps, but the super deduction goes even further than this. And I'll show you on the next slide an illustration of how this works. So I've got the same example, £100,000 being spent on some qualifying equipment, and we'll go into a bit more detail later as to what does actually qualify and what doesn't. So you can see, prior to the super deduction coming in, we can claim annual investment allowance. We can reduce our profits by £100,000. That's the amount that we spent on the equipment. And that gives us a reduction in our tax bill of £19,000. Now with the super deduction, what happens, instead of just reducing our profits by 100,000, we actually can reduce our profits by 130% of the qualifying expenditure. So in this case, we can actually reduce our taxable profits by 130,000. So that's actually more than the piece of equipment cost in the first place. And then we get our 19% reduction in corporation tax. And you can see that reduces our tax bill by just under £25,000. And then you can see when the super deduction ends in April 2023, that's the same time that our corporation tax rate is going to go up to 25%. And so you can see that from April 2023 onwards, it's going to be a similar kind of result. Hopefully you'll be able to reduce profits by 100% of the expenditure. That reduces our tax bill by 25%, 25,000. So I think you can see from this illustration that in reality, with the super deduction, you're basically getting a tax deduction now as though the corporation tax rate is 25% ahead of time. So we think it is a really generous relief, and it's definitely worth taking advantage of. I think that's probably the first takeaway from today's event is it's a generous relief. It's good. It's not capped like the annual investment allowance is. So it's a brilliant result, brilliant relief. It's worth taking advantage of. And in view of helping you to do that, we're going to now turn to some more practical examples of what does and doesn't qualify. So I'm going to hand over to Jerry for that.
Thanks, Carl. So do you want to cover off in a bit more detail the kind of things that qualify, and also some detail on some of the things that don't qualify, just so you know where you are. But I guess firstly, the first thing with a super deduction is that it only applies to companies. So like a number of other tax reliefs, such as R&D tax reliefs and patent box, they only apply to companies as opposed to partnerships or sole traders. So if you are in a partnership or sole trader company business structure at the moment, it might be worth just reconsidering that. Make sure that you're factoring in the benefit of some of these reliefs that you're perhaps not able to qualify for at the moment. So turning to what qualifies for the super deduction, the main qualifying assets are some of the things that you can see on the screen here. These are kind of typical examples. There's obviously lots of others as well, but things like office equipment, warehouse racking, machinery of most kinds, commercial vehicles, so that includes things like vans and pickups, computer equipment, and even electric vehicle charging points. The other thing is that it needs to be unused and not secondhand, so it needs to be brand new equipment. We would expect, however, that ex-demo equipment would qualify based on HMRC guidance for similar reliefs. So even if it's got perhaps a van that's got a few miles on the clock, we'd still expect HMRC to allow that to qualify for the super deduction. Software doesn't qualify by default, but you can elect for it to be treated as plant and machinery and therefore qualify for the super deduction. So the main kind of takeaway on that is that if you are thinking of spending significant amounts on software, maybe a new ERP system or something like that, make sure you speak to your accountant to make sure they make the election so that you can claim the super deduction. In terms of assets purchased on finance, anything that's obviously purchased outright is fine. Anything purchased on hire purchase is also usually fine to claim the super deduction on. But other forms of finance, such as finance lease or contract hire, don't qualify for the super deduction. The defining point being whether the company actually acquires the asset at the end of the finance term. So it might be worth just thinking about the impact on costs if you're comparing the cost, for example, of buying a commercial vehicle either on hire purchase or some other form of vehicle finance. Just factor in the potential tax benefits of the super deduction and make sure that you may find that it actually works out cheaper overall to go for the hire purchase route, even if it's not quite as good a deal. One further point as well, we're used to being able to expensing things, putting things through the profit and loss as an expense being the best way to get a tax deduction. But for the first time, we're actually in the position where the super deduction is actually giving us a better, higher corporation tax deduction than just putting something through as an overhead. So it might be worth just revisiting your expensing kind of rules that you use internally for what criteria or what level at which you expense things. If you can justify capitalizing something, if it's got a useful life of more than 12 months usually, then it may well be worth doing so and seeing if you can benefit from the super deduction. So just turning now to some areas just to be aware of that don't qualify for the super deduction. Firstly, cars, and also just to be aware that, as I think we've mentioned before, combi vans, so particularly those that have got a second row of seats in the back, are, following recent case law, usually treated as cars rather than commercial vehicles for tax purposes. So just be aware of that. And the other thing is assets that you purchase for the purpose of leasing out. So the obvious example being a hire fleet, for example, if you're buying equipment which you then rent out to your customers, that wouldn't qualify for the super deduction. The other scenario where this can crop up is where, for example, you have a holding company that you use to purchase and own certain valuable assets, like valuable items of machinery or equipment, because the holding company is buying it and then leasing it to the trading company, then the holding company would not qualify for the super deduction. So that's an important point to be aware of. So what we're advising in the meantime, while the super deduction is operation for the next couple of years, is that you should buy the equipment at trading company level and claim the super deduction. And then at some stage in the future, if you then decide you want to move it up into the holding company to protect it, that should be fine. Finally, on property improvement costs, which is a particularly kind of complex area when it comes to capital allowances, and what tends to happen if you've got a big property improvement project is that you'll have a range of different costs. Some of them won't qualify for capital allowances, some will qualify for one thing, some will qualify for something else. The most important thing is to make sure that you do get a fully costed breakdown from your builder or your contractor, and go through this with your accountant just to make sure that you're maximising the available reliefs. And you'll find that some things do qualify for the super deduction, other things may not. There is, alongside the super deduction, another relief was announced called the SR allowance, but instead of giving 130% deduction, this only gives a 50% deduction. So it's actually not as good as the annual investment allowance. So I think if it doesn't qualify for the super deduction, we would go for the annual investment allowance rather than the SR allowance. The other thing as well, just to be aware, as Carl touched on earlier, that the subject to any announcements otherwise in the budget, the annual investment allowance is dropping from £1 million down to 200,000 from the 1st of January. So just be aware of this and make sure that you're thinking about bringing forward expenditure if that is needed in order to get the maximum use of that. The other thing as well is there are some transitional rules around if you don't have a December year end, which can catch you out. So just double check with your accountant if you have got any big spend items coming up. So that kind of summarizes the what we had to say on the super deduction. Just some takeaways. Firstly, obvious point, but make sure you use the super deduction. It's a generous and an unlimited relief, so it's not capped like the annual investment allowances. Make sure if you're wanting to use it for software that your accountant makes the relevant election. Use the annual investment allowance, we'd suggest, rather than the SR allowance where that potentially applies. Buy equipment at trading company level rather than holding company level for the time being, because that will allow you, assuming it's a qualifying asset, to claim the super deduction. And if you're looking at finance, we'd encourage you to consider hire purchase rather than other forms of finance, because that will allow you to access the super deduction. And finally, review your capitalizing policies and make sure you're capitalizing as much as you can within reason. So that's a bit of a summary on the super deduction. Back to you, Carl, to take us through the next point on the agenda.
Thanks, Jerry. So the other key announcement we were going to talk about was the new health and social care levy. I guess everyone will have heard something about this over the last few weeks. Really, though, in simple terms, it is a new tax, an additional tax to pay for a funding gap which has arisen in health and social care. So I'm just going to explain this just to give everyone a bit of background so we can understand where this is coming from and why it has appeared. So, as I say, it's really to cover a funding gap in health and social care that's really arisen for three main reasons. The first one is the NHS backlog due to COVID. So there's obviously been a huge backlog in the NHS as a result of COVID, and additional funding is needed to help overcome that. Coupled with that, we've got increased social care costs generally with an aging population and so on. And then thirdly, and probably most significantly, ultimately, the government has introduced or is going to introduce a cap on social care costs for individuals. So up to now, many will be familiar with the situation where individuals with assets over £23,000 have had to fund all of their care costs themselves, which inevitably in some situations has resulted in older individuals selling their residence to actually pay for care home fees and so on. Everyone will be familiar with that situation. Well, from October 2023, the scene is changing quite significantly on that front. And from then, there'll be a cap of £86,000, which means individuals won't have to contribute more than £86,000 to their care costs, obviously subject to various other conditions and thresholds, but that's the main point. And so the government are planning to ultimately fund that through the introduction of this health and social care levy. So they're really the three main drivers behind this, the introduction of this new tax. Jerry's going to just run through exactly what it is and how it's going to impact you and what we should be thinking about as a result.
Thanks, Carl. So just to explain briefly what it is, how it works. Essentially what it is a 1.25% increase across these four taxes that we've got on the screen. So employees' national insurance, employers' national insurance, 1.25% added to all of the dividend tax rates, and also 1.25% on top of self-employed national insurance, class 4 national insurance that sole traders and partners pay. Technically speaking, it is a separate tax, but for the first 12 months from April next year through to the end of March 2023, it will be added to the national insurance rates, and then from April 2023 onwards, it will be levied as a separate tax on people's pay slips. The other thing as well is from that date, it will apply to all workers, even those that are over state pension age. So that's from April 2023 onwards. However, the usual reliefs for under 21s and apprentices will continue to apply to the new levy as well. So you can see that effectively it's actually a bit of a double whammy for employment costs. So the total employment cost is going to increase by 2.5% on those wages above the relevant thresholds. But I guess in the broad scheme of things, it's not a huge increase. It accounts to 25 quid for every extra £1,000 of pay. I think most would see it as a proportionate increase to cover the additional costs that the government's facing. So in terms of kind of takeaways on this, obviously this is all quite new, but I think the main thing is to make sure you're budgeting for the extra cost in your business budgets from next April. Make sure that you are using all of the relevant dividend allowances before the end of this tax year, so by 5th of April next year, and make sure that all shareholders are utilising as much as they can their basic rate tax allowances before the rates go up. And finally, just to review your profit extraction strategy and just make sure that it's as effective and tax efficient as it possibly can be from April 2023 onwards. And there's a number of things that you might want to look at to just make sure that you are utilising what's available. So I hope that's clear. I'm back to Carl. Thank you.
Thanks, Jerry. So just before we move on to the question and answers, we've had a whole load of questions come through, which is brilliant. But just before we move on to that, just wanted to mention that you need to look out for a surprise gift coming into your inbox following this event. It's actually our 45th birthday here at Oldfield, and as a part of the celebration of the birthday of our firm, we want to give something to all the attendees of this event. So look out for that coming into your inbox very shortly after this event finishes. So we'll move on to the questions and answers. I'll get these pulled up. So I've got a question here. Does the super deduction, does this include investment in vehicles? So I think probably the answer to that, I think Jerry probably covered that off, that the super deduction doesn't apply to cars in general. But what it does apply to is commercial vehicles. So things like vans, pickups, those kind of commercial vehicles, they're treated as plant and equipment effectively. And if they're new or ex-demo, they should qualify for the super deduction. Another question here, do solar panels qualify? What do you say on that one, Jerry?
I think the answer to that is that they wouldn't qualify for the super deduction, but they do fall into the class of assets that qualify for the SR allowance. So I think in that case, we'd probably be suggesting that you claim the annual investment allowance if you've got scope to be able to do that. It gives you 100% relief.
Yeah, that's good. So it's really, we can use annual investment allowance for solar panels. So that's the best route really to go down at this point in time. That might change as the actual cap on the annual investment allowance changes as we go forward, but that's as it stands at the moment. Got a question here about software allowance, about allowances for software. I think the key point on that Jerry mentioned was that software can qualify for the super deduction, but you just got to do an election to treat it as plant and equipment. So as long as you do that election, then you should be able to get it to qualify for super deduction. We've got some questions coming in here about the timing of expenditure and when the super deduction kind of runs to and from. So I've got a question here. Does capital spend need to be made in 2021 to get the super deduction? If you've got spend that's spanning from 2021 into 2022. I don't know what you say on that, Jerry.
Yeah, so to answer the question about the timing of the super deduction, I think that spans a 2-year period, any expenditure from the 1st of April this year through to the 31st of March 2023. So any spend that falls in that time frame potentially qualifies if it's a qualifying asset. There are some transitional provisions related to when it was announced in the budget, but I would imagine we're probably beyond all of that now anyway for anybody that's, certainly for anyone that's planning any new spend. It would qualify from now until, as I say, the end of March 2023. In terms of the property improvement aspect, I think that's going to be a case where there's going to be some assets that qualify for the super deduction and some that we might be looking at using other reliefs for. So that's probably one that you'd have to look at the detail of what you were spending and get that breakdown.
Thanks, Jerry. We've got a lot of questions flooding in. I'm not sure, we're not exactly going to be able to cover all of them, but we'll try and pick out just a couple more before we close off. I've got a question here about 2 forklift trucks coming to the end of a 5-year lease and looking at the possibility of purchasing those outright as second-hand machines. Question of whether that's outside the scope of super deduction because they're second-hand. I don't know what you'd say on this, Jerry, but I would say that they're, because they're not new or unused, they're actually second-hand machines, that they won't actually qualify for the super deduction, but they will still qualify for annual investment allowance. You could still get a 100% deduction for those 2 forklift trucks, but you just wouldn't get the extra 30% that the super deduction offers. A few other questions here. Probably just got time for one more. So a question about mezzanine floors, which is always an interesting one. What do mezzanine floors qualify for? Jerry, do they qualify for the super deduction? Do they qualify for annual investment allowance? How does that work?
Yeah, it's a good question. I think it's probably one of those it depends sort of questions. I think what we've generally said in the past is that if it's kind of a self-supporting or standalone structure, that you could kind of you can bolt into place and you can unbolt and take it away without kind of damaging or having to alter the structure of the building, then that would be I think an asset that qualified for the super deduction, provided it was bought brand new, obviously, and by a company. But if it was part of the actual fabric of the structure, such that it actually becomes part of the property, I don't think that would qualify normally.
That's good. Thanks, Jerry. I think that's clear. Good. Well, I think that really concludes the session. It's been really good to have everyone on board, and thanks for all those questions. That's really good. Hopefully everybody's found that useful and can take away some practical tips to maximize these reliefs. So thank you very much for joining. Goodbye.